Hey guys, how's it going? It is my 25th birthday, and to celebrate, I wanted to talk about 25 stocks I love going into 2022. I'm going to break these stocks down into 3 different categories. There are stocks that I like for growth going into the future that they might not be taking off right now, but I think they have high expectations for themselves, and I agree with them going forward. We have stocks that I think are incredibly stable. These are stocks that have returns that you can look back on and feel good about owning them into the future. And then number 3, I'm going to talk about stocks that have fallen significantly in the past year. I'm going to put this into my cheap category. These can be stocks that I think have incredible value, and I think they can be stocks that maybe were great stocks in the past, but have had a rough past year, and I think they'll rebound. Also, this month, anytime you guys comment a stock you guys want to hear about, if you put in the comment section down below at the end of the month, I'll compile them into a large video, and I'll talk about them. Also, before getting into the video, it is my birthday, so I will ask for likes and subscriptions. It really helps me out and tries to grow this channel. None of these stocks are put into any particular order, and I'm just going to talk about a couple things that I like from each of the stocks. Some of them I like more than others, but I think it's a good variety of stocks, and these are stocks I'm looking to buy during the course of this year. Might not be right now, may not be a month from now, but it will be by the end of 2022. The first stock on this list is the most stable company out there, and that's going to be Apple, ticker symbol AAPL, which is up 33.5% in the past year. Apple was the largest stock when you take into account market cap, and that is the stability that I'm looking for. This is likely going to be one of my core investments for the next decade plus, and I continue to add to it anytime the stock market falls. And as the market's been falling recently, it has become a very attractive investment. We'll see if it continues to fall further. Next up is going to be Adobe, which is only up 7.7% in the past year. One of the reasons why I really like Adobe, I forgot to mention it's a stability play, is they're switching their business model. In the past, they were a company that sold their software, and it was just a one-time purchase. And I love companies that are able to transition away from that one-time purchase into a subscription model, which is how they've been selling all their products. Photoshop, Premiere have become industry favorites, and I don't see them going away anytime soon. They've been partnering up with Microsoft to do some, I think it's 3.ai, which is some CRM stuff, and I like the future of Adobe going forward. Next is going to be my top stock of 2022, as it was of 2021, with General Electric, ticker symbol GE, which is up 10.7%. I'm going to put this as a growth and a cheap play. It was up in the past year, but when you look back to how far it's fallen in the past 5 years, I think it does have a long way to go, and I think that's very attractive for a long-term investment. I don't see them rebounding in the next week, month, but I think in the long run, GE is a fantastic investment for my portfolio. And then for the growth aspect of it, I think the renewable side of the business is super attractive. You have the recovery aspects of the aviation, but the fact that they're going to be breaking up into 3 separate companies in 2023 and 2024 makes it so that I can focus on the parts of the GE business that I really care about, which is the power, which encompasses the renewable energy part of the business. Then number 4, let's go to Microsoft, ticker symbol MSFT, which is probably one of the more stable companies out there, up 44% in the past year. It is a company that one of the most attractive things for them is that their revenue sources are broken up pretty much evenly into 3. And I love a company that, you want a company to succeed in what they do, but the fact that they can succeed in 3 parts of their business, where you have something maybe has a problem during the pandemic, the other areas of the business can make up for that lost revenue, and that's why I really like GE going forward. Next up is going to be Southwest, ticker symbol LUV. That's down 4.4% in the past year. Southwest has always been my favorite airline to ride as a passenger, also to invest in. It is a company that I currently own. I think it's super attractive because of the type of business that they're running. They have very simple operations. They fly the same types of planes, and they fly mainly domestic routes, which with this pandemic ramping back up again and borders potentially closing, I think this makes it so that GE is less of a risk compared to some of the other airline stocks out there. And anytime I talk about airlines, I get a bash on American Airlines. Don't fly them, and their stock is horrible. Also, when I put up revenue for Southwest, you'll see the recovery since the pandemic. It is still not up to where it was, but you're starting to see the trend go in the right direction. Next up is going to be PayPal, ticker symbol PYPL, which is down 21% in the past year. I'm going to put this as growth and a stable play. And you might be asking, it's down 21%. How can that be a stability play? When you look at the history of PayPal for the past couple years, its returns have been incredibly stable. This one-off year I don't think is going to dictate what they're doing going forward. I'm very comfortable putting my money into PayPal, even though it is down 21% in the past year. When you look at it, their revenue has always increased quarterly. I think that's not something you can say about a lot of companies. And I think PayPal is just a company that I prefer over something like a Square. I use PayPal, I use Venmo, and I like them more than Square going forward, so I'm going to put PayPal on my list. Next up, let's go to a Oregon Classic with Nike, ticker symbol NKE, which is up 7% in the past year. This is a stability play. This is not a stock that's going to double in any given year, but it's been incredibly stable, and the pandemic has shown that they can transition their business to online as well. This has mainly been a brick and mortar type of company, but they've shown they can push their revenue online, and I love that. They do have a decent dividend. It's not great, but when you're investing in a company for the long run, they'll start to add up over time, and Nike has always been a stock that I really respect the company, and being an Oregonian now, I want to invest in going forward. Next, we're talking about Brookfield Renewables, ticker symbol BEP, which is down 28% in the past year. This was one of my more underwhelming stocks from my portfolio in the past year. It's a stock that I've invested in heavily, and I just kind of thought that they'd do better, but renewables as a whole had a really tough 2021 as the instability has kind of pushed some of the high flyers. Brookfield was up significantly in 2020, fell a decent amount in 2021. They have a dividend at 3.6%, which is very attractive. But the thing I really like about them is their portfolio. They are well established when it comes to renewables. They have, I'm going to put up the graphic right now, of hydro, wind, solar, and transition power, and the stuff that's going into development in the future. So this is something that you're investing in a company that is already well established, and they are going to continue to grow going forward. Also, this graphic really sells me on the whole transition to net zero when it comes to carbon emissions. There's going to be a lot of money and effort put into getting companies, countries, and communities to net zero, and something like a Brookfield Renewable is going to be able to take advantage of that. It's something that I'm investing with my morals, and I believe it's going to be a beneficial investment in the next couple years. Next up, let's talk about NextEra, another renewable energy company, ticker symbol NEE, which is up 8.4% in the past year. NextEra is slightly different when it comes to Brookfield Renewable because it is the largest energy provider in Florida. They own Florida Power and Light if you live in that region, but they also have a pretty extensive renewable energy portfolio. And so when you look at their operations, they have some pretty impressive numbers when it comes to their generating capacity, and having Florida Power and Light brings in recurring revenue that allows them to supplement some of the choppiness that you're going to see with renewables on a quarterly basis. But when you look at their returns since 2009, they've been incredibly stable, and you can't say that about a lot of other renewable companies, and that's why it's a stock that I've owned for a year and a half plus, and I'm going to continue to add. They do have a dividend that pays a decent amount. This is how I expect Brookfield Renewable to look in the future, but after a tough 2021, NextEra has been kind of the pinnacle of my renewable portfolio. Next up, let's go to Lemonade, a stock that's had a really tough time, down 80% in the past year. We're going to put this as growth and cheap. For those of you that don't know, Lemonade is an insurance company that's focusing on AI. It's supposed to be the 21st century version of insurance. Going through an insurance company is a tedious, horrible process, and they're trying to make that easier. They're also a Class B Corp, which means that they have reached certain levels of social, environmental responsibilities, which is not something you can say about a lot of other publicly traded companies. They do have a lot of problems, obviously, based off the fact that they're down 80%. One of the main things that really stuck out to me from the research I did for this video is that 120% of their revenue was spent on marketing. So if they can retain these clients that they're spending all this money to get, I can see them growing into the future, but that is not sustainable. Obviously, you can't be spending 100% of your revenue on marketing. Lemonade is a stock that I like the idea of it. I don't know if it's a fantastic investment opportunity, but if things start to settle down with the overall market, I do love the discount that you're getting. It's hard to say that for a company that I do like and I do believe in going forward, an 80% discount in 1 year is pretty unheard of. Next up, let's talk about something more stable with SPY. This is going to be my stability, up 23% in the past year. S&P 500 ETF, it's going to follow the overall market. Returns on average 10% a year, and had a fantastic year in 2021, being up 23.6%. Next up, we're going to go to more stability with the Nasdaq ETF, QQQ, which is up in the past 5 years, 208%, and in the past year, 21%. Technology stocks have been the way to go for the past couple years, and QQQ, I think, is the best way to encompass all of the tech stocks without having to pick your favorite. Next, we're going on a roll of ETFs. We're going to go with the solar ETF, which is TAN. I'm going to put this as growth and cheap because it's down 39% in the past year. But when you look at the market for solar, it is still pretty much in the infancy of how it's going to go. It's still relatively cheap, but the prices have come down recently, and the abilities for these companies to provide solar power at a reasonable price has gone up. And when you look at the expected growth Solar power is currently a $12 billion industry in the US, and growth in the past year has been 11.1%, and solar power in the US annualized market size growth from 2017 to 2022 is 15%. Double-digit growth is very encouraging, and as I mentioned, we're still pretty much in the infancy of solar being a reliable way to generate power for more than just the largest companies. We're trying to see this in a residential sense as well. This is not something that I don't see it recovering anytime soon, but as it is a part of my portfolio, I'm going to continue to add to it to try to lower my overall costs. Next up, we're going to go with a bank stock with JP Morgan Chase, ticker symbol JPM. With stability, it was up 21% in the past year. When you look at the bank stocks, I think they're in a really good spot going forward. The earnings report is coming up, and I expect to see some good numbers from there. When you graph them for the past couple years versus Wells Fargo, which is WFC, and Bank of America, you can see that Bank of America and JP Morgan are miles above Wells Fargo. I wouldn't touch Wells Fargo with a 10-foot pole, whatever the saying is. And then I have a personal gripe against Bank of America, so I'm going to pick JP Morgan Chase. I think the rising of interest rates is going to allow them to creep up the interest rates so they can make more of a profit, and I think that's going to help them in the long run. Next up, we're going to go with Intuit, which is ticker symbol INTU. For those of you that don't know, these are a type of company that does a lot of financial services software. TurboTax is probably the main one I think about, and this is a stability play. It's up 52% in the past year. When you look at its returns for the past decade plus, it is pretty impressive. This is a stock that has recently popped back up onto my radar. I didn't think it was that attractive, but when I put up the all-time chart, it's pretty attractive. Next up, we're going to go with more stability with Costco, ticker symbol COST, up 47%. It's hard to really knock them. They've been incredibly stable. When you put up the revenue, it just continues to grow. I love the product. I think that people love the stuff that they're producing. When you have a subscriber base that are so passionate about the product that they're putting out, they don't feel like they're getting scammed, and it's profitable for the company and beneficial for the people that are using the product, it's hard to argue against it. Next up, we're going to talk about McDonald's with more stability, up 25%. The whole thing about McDonald's is, yes, they do own fast food chains, but the main thing is that they are owning the properties and leasing it out. The big number to think about is that 85% of the properties are leased out. They do pay a dividend that's pretty nice, but having the leasing and owning the actual land makes it so that pretty much a real estate company that runs fast food chains on top of them, and not only a fast food chain. So I think that's always a fascinating thing to talk about. Going back to recovery and growth going into the future, we're going to go with Boeing, ticker symbol BA, up 4% in the past year. This is a stock that fell before the pandemic even hit, and then the pandemic just knocked it down even further. So we'll call this a cheap stock. It has recovered a little bit in the past year, but it still has a long way to go to reach the more than $400 price tag it was before the pandemic and before those plane crashes. I think it's pretty attractive. I thought it would recover sooner rather than later, but I think the pandemic is really prolonging that recovery. Next, we'll go to another airline with Delta, ticker symbol DAL, for recovery and stability, up 5% in the past year. I love Southwest for the product that they put out, but for an investment side, I like Delta a lot. They're going to be hampered by the variants coming out and the potential closing of international borders. When you look at these airlines, the way that they're really going to be making money is the international long-haul travel. And with that being kind of up in the air right now, it might be a little difficult to warrant buying into a company like this right now. But I think in the next year, there's going to be some attractive times to be buying into Delta. Next, we'll go with Lululemon. I'm going to talk about them with growth, down 2% in the past year. The main thesis that I had for why I love Lululemon was the fact that they spent $500 million acquiring Mirror, which is going to be this fitness product that was kind of going to compete with something like a Peloton, the stay-at-home movement. Things have not gone super well with that. I hope that it will rebound in the future. People are talking about, the easing of the pandemic restrictions, allowing people to go back to gyms. In the summer, we had talks about the weather being nicer. I do think it's going to be a nice revenue source for them in the future, but just right now, it has not met the expectations of the company. And as a result, the stock has fallen pretty significantly recently. Next up, we're going to be talking about Clean Harbors, ticker symbol CLH, which is going to be the newest addition to my renewable portfolio, and they're going to be part of my growth portfolio, up 17% in the past year. For those of you who don't know, this is a company that helps a lot of the major Fortune 500 companies deal with waste. These are stuff that could cause major ecological damage. And so having a company that is put in place to limit some of the downsides of that, I recently at work had to go to a place where arsenic was dumped into the soil. This was back in the 50s. And so we're trying to avoid situations like that. And Clean Harbor is going to be the company that's going to try to limit the damage and make it so that you don't hear about all these horror stories in the news about ecological damage. Next, we're going to go with Snapchat as a cheap and growth stock, down 24% in the past year. Snapchat is one of those stocks that did really well in 2020 when financials weren't really an issue. They were looking at user growth, which was always been super attractive. Some of the numbers with Snapchat are just staggering to see the amount of people that use the product. Snapchat has 306 million daily active users, and the crazy stat to me is that over 75% of 13 to 34-year-olds in the US, UK, Australia, France, Netherlands use Snapchat. That is a crazy amount. From what I've seen, I am kind of old now because I'm 25. It seems like kids are communicating through Snapchat more than they are through texting. And so we're seeing this switch, and having 306 million daily active users is very impressive. They have slid a lot recently off of some wider than expected losses, and it is still pretty expensive when you look at their price to sales. P over S is 19.2, which is higher than pretty much any company that you could find on the stock market right now. The last earnings report, the numbers were pretty good when you look at revenue, up 57% year over year. And at ARPU, which is probably the most important metric, which is average revenue per user, increased 28%. Super nice to see them going in the right direction. But their net loss was still $72 million. But when you see that it improved by $128 million, that's nice. They're going in the right direction, but they're still losing a lot of money, and investors are being more wary of that right now. Now we're going to talk about the most controversial one on this list with Alibaba, ticker symbol BABA. It's going to be a cheap stock, down 43% in the past year. Alibaba has had probably the worst year that any stock has had. They've had problems with their IPO getting blocked by the Chinese government. They had a major fine by the Chinese government. And now the worry is that the Chinese government is kind of after Alibaba. Even with all that bad news, being down 41% in the past year, they just continue to report incredible earnings. And so even with all the bad news, their revenue was still up 39% in 2021. So Alibaba, there's a lot of risks. You're not only investing in the company, you're investing in the stability of the PRC. And if things start to get worse than they already are with Alibaba and the government, that's not really something that's in your hands. So Alibaba is something that I'll always be watching as a potential opportunity, but it is very different than investing in any other stock that I've mentioned. You're not just investing in the company, you're investing in the stability of the Chinese government. Next, we'll go to Coinbase, which I'm going to put as a growth stock and a cheap stock, down 29%. Coinbase recently went IPO, and as the crypto movement continues, and as the crypto market cap closes in on $2 trillion, Coinbase is in a great spot to take advantage of that. 96% of their revenue comes from transaction fees. And when you look at their highlights, they have 73 million verified users in 100 plus countries, and they have $255 billion of assets on the platform. So Coinbase is definitely going to be the leader when it comes to crypto in the places that you're going to be investing. And so I think that as crypto increases in popularity over time, Coinbase logically would continue to grow because of it. And then finally, we're going to finish up the video with Chargepoint. Chargepoint is a stock that I didn't really think much about until recently. But when you think about the electric car movement, besides Tesla that has all of the charging stations set up, how else are these other cars going to be getting power? And I think Chargepoint is in a great spot to take advantage of that. In the past year, they are down 60%, which is why I put them as a cheap option. But they've been increasing their revenue over time, but they've had a wider than expected loss in the past couple quarters. This is the type of company where you're not going to be seeing a profit for a long time. But as the electric market continues to go, and increase, it's expected to grow at a compound annual growth rate of 21.6% from 2020 to 2028. That is huge growth numbers, much larger than some of the other growth metrics that I've mentioned so far in this video. As the electric vehicle market continues to grow, Chargepoint I think is in a great spot to take advantage of that. Some of the summaries from their website is that they currently have 163,000 places to charge on the Chargepoint network in North America and Europe. They've been in business for 13 years, which is not something you can say about a lot of other EV companies. And it's very exciting to see what the electric market is going to look like in the future. And I think Chargepoint is in a great spot to take advantage of those growth numbers. So, and then finally, we're going to wrap up the video with Peloton, ticker symbol PTON. I forgot to look up how much it's down. Let's take a look. It's up 5% on Friday, but in the past year, it's down 76.6%. Peloton is a stock that did incredibly well during 2020. It was one of the stocks that was associated the most with the stay-at-home movement. Since that point, they've had some struggles with supply chain, with people going back into gyms, and their numbers have not looked as good as people expected. I think that this is a product that people absolutely love. They might not reach the previous highs of $150, but I do think that there is a very interesting case to be made for Peloton being a solid stock to own for the future. Will it continue to fall? Maybe. A lot of these stocks that did incredibly well in 2020 and 2021 continue to fall, and Peloton may continue to do that. It is a part of my portfolio, and I'll continue to add to it because I do believe in the vision, and I do believe in the company, even though it's had a really tough time in the past year. So those are my 25 stocks I'm looking to buy in 2022 on my 25th birthday. Very curious to hear what your guys' favorites are and what you guys liked or didn't like about my list. There's some stocks that are not here for everyone, and there's some stocks that maybe I missed out that you think are great opportunities. Be sure to leave them in the comment section down below, because any stocks that are mentioned in the comments, I'll put them into a video at the end of the month and talk about your favorite stocks. So thanks for watching. I appreciate all the support, and I will see you in the next video.